Welcome back to another episode of Palisade Radio. I am your host, Karema Mutlu. And on today's show, we welcome back Frank Holmes, who's the CEO and Chief Investment Officer at US Global Investors. How are you today, Frank?
I'm well, thank you.
Let's begin by talking about the gold market today. At the beginning of the year, you talked about gold having the potential to have an incredible run. You suggested that gold would pass through the $1,900 area within the next 3 years. So has this run now officially begun? What are your views on gold today, Frank?
Yeah, they have done. There's no doubt the gold is in an uptrend. Then the global PMIs, which are really important about global economic activity, had peaked last year. And that was always, of a concern. And PMI, for your listeners, is Purchasing Manufacturers Index, is something I write about every month. And I like to take a look at 1 month, is it above or the 3-month average? And what is that trend? So it's better to follow the trend than the headlines. And it's a great leading indicator because it reflects that if anyone's going to be manufacturing something, they're going to consume a lot of metal and they're going to consume a lot of energy to make something. And it's usually a precursor for 6 months out economic activity. And what we have seen is that when the 1 month is above 3 months, we see copper, iron ore prices, these metals start to pick up, and vice versa. When it goes below, we see them fall. And the correlation is also pretty strong with energy prices. So we had seen this slowdown, and we were looking for rates to fall to try to stem it. And when you had the combination of the trade war, Karim, that trade war only exacerbated it, because the trade war, when you look at global macro forces, is so important to look at China and India, when you're looking at consumption, because they're 40% of the world's population. You're talking about lots of mouths eating lots of food every day and consuming lots of products every day. Now, when you're going to look at global trade, it's China and America. Combined, they're 40% of all global trade. So what we had was this, all of a sudden, the two biggest economic global traders are going into a spat with each other. And that means we're going to have a slowdown. Well, we have a slowdown upon another sort of a cyclical slowdown of consumer spending, then you have rates falling. And what we're seeing now is pushing close to 30% of government bonds around the world are negative. They're offering you a negative real interest rate. What does that mean? You say, what is the government trying to seduce or induce me to buy their 10-year government bond, and I've got to take away the current inflationary rate? And if that rate is negative, it's pretty severe. It's a high-risk investment. And in fact, it's so bad in Europe that the Danes are trying to pay you to take out a mortgage. This is always very bullish for gold. And I think we talked last time, it was a peak gold scenario, that there's no frackers that have come into this industry as of yet. They can fast track the development of a gold mine, but you have this money printing taking place. And now we not only have money printing, we have negative rates of return.
In the past, Frank, you have talked about AI technology and how that can help the mining sector to find new deposits more quickly and easily. With a lot of new technologies, most companies can be slow to implement new changes. So do you think within the next 10 years, most mining companies will have an AI technology department as part of their drilling campaign? How do you see this unfolding?
When you look at technology and the significance of what it's done, there was peak oil. We did have peak oil until the frackers came along. And the frackers predominantly come in countries where you have common law, where they own the property. And it's really important to recognize that where you have the eminent domain, there's just more innovation and creativity than where you have civil law versus common law. And the frackers, no doubt, were game changers. We've not had that in gold. There's been no big push. And I think also that the EPAs of the world make it a much longer life cycle from the day of discovery to the date of production. So there has to be some regulatory change there to attract it. But technology-wise, nothing except for along comes AI, and along comes a stock, a company, a Goldspot, which I put money into, and a couple of $1 million I invested and became the chairman, because I'm a big believer in the use of this technology. And what I found was that this technology really de-risks exploration. And that's really important because the success of so many dollars being spent, and it didn't matter when gold was 1900 and they were spending 100 million, more than that a year on exploration. There were very few 3 million ounce discoveries. So you have to have a new approach to look for gold. And what I discovered with the guys and girls behind Goldspot is that you have 9 PhDs. And they're using algorithms and machine learning, and that a mechanism in the cloud allows them to take all this data and crunch it far superior than even a great geologist can do. A great geologist can process 4 different types of views of maps: a geostatistical, geophysical maps, etc., some partial drill hole results and ships, etc., and they can put together a picture. Well, these guys can put together more than 20 in a second at the same time. So what do? Is they make spending much wiser. They make spending much better. It's a little more costly to use such services, but really it de-risks exploration dollars. And so if we get back to the dollars being spent before, then I think we can have more discoveries. I think it allows exploration companies, junior exploration companies, to get a bigger bang for their buck. And if I'm an investor, which I am in junior exploration companies, then it should give me, a much better advantage in getting that $1 going much further in looking for new deposits.
I'd like to understand, Frank, how you rode the gold bull market from the early 2000s to the most recent peak of 2011. In terms of junior mining companies, did you pick explorers or developers? And after such a long bear market, has your strategy changed in how you view the junior mining industry and the opportunities it now presents?
Well, the markets have really changed dramatically, and it's a combination of excessive regulations coming out of Europe with MiFID II. MiFID II wiped out $1 billion of analysts on the sell side giving you research. 1 billion gone in the past year. The MiFID, the socialists out of the EU, basically do not want to have any investment conferences like you and I being together at Jekyll Island. They don't want that. They want to control taxation and where their money goes and spends. But fortunately, there was a protest against it, and conferences like the Denver Gold Show still take place. This sort of excessive regulation has impacted the narrative, such as the definition of what is a fiduciary, a fiduciary risk. And you've seen how it's being appreciated in Europe is different than Canada, and the same thing in the U.S. And so it's more speculative money. One of the great concerns I saw a couple of years back was speculative money was going into racetracks, casinos, lottery tickets, but it was basically being pushed away from exploration or new technology. And young people were putting money into cryptos. So something $5 billion went into that crypto space. And so you need to have, for the junior mining space, you have to have the spirit of speculation. And that person that has more disposable income to speculate is usually my age. They're older. And then according to the interpretation of the fiduciary rules, et cetera, well, I should not be investing in that such speculation. And that creates a difficulty in the flow of capital. So that's something that I've really seen. I've also witnessed the quant approach to picking stocks. That's another reason why Goldspot I really like as an investment, because a PhD, if you're raising money in Silicon Valley, can raise about $5 million US. Well, they have 9 people. That's worth $45 million US. That's gross Canadian 60 million. So Goldspot's at least worth $60 million, which is double the stock price is trading at. Because the reason for that is because the quants can cut through noise and they can give you a better statistical approach to making that risk. And so that world's changed, and I launched a smart beta passive, but it's really a passive structure, but it's active because it recalibrates every quarter. ETF on the New York Stock Exchange called Go Gold. Go AU is the ticker. And based on 10 years of regressional studies, 8,000 hours of research, and that's what quants do. And you have to scrub the data. That's what Goldspot has to do. Scrub the data, cleanse the data. It's a lot of work on cleaning data, come up with something. And when we came out with GoAU, it outperformed the GDXJ 92% of the time on rolling 12-month periods over 10 years. That's 40 quarters of data. It has a 92% outer performance. So we launched it 2 years ago. It outperformed by 16% over 2 years and 10% year to date is what the data was reflecting recently. But I think that this approach is so important in that you have to, with a new operative word for your listeners, is called quantamentals. I'm going to repeat that, quantamentals. And that quantamental approach is so important to picking a stock or doing analysis of data for a gold stock, picking which Goldspot does. And so now when we look at these junior mining companies, we're looking at, do they have a quantamental approach? Does the CEO embrace this technology? Do they embrace it for marketing their story? How are they using where they're placing their ads? Are they doing lots of interviews with organizations like yourself to tell their story? Or they're just hiding behind their desk? Those geos that hide behind their desk are usually not embracing AI for mining exploration, and we're just not going to take a risk with our capital with them. So we have found that some of the gold stocks that really popped in this past 6 months, the juniors, is because they're always out telling their story and they come out with good results, and they actually can have 50, 60, 100% appreciations of their stock prices. Those that don't, and you can use AI to place your ads on Facebook. You can use AI to place your ads on any domain. If they don't use that in trying to help them do their story and interview, then they're not going to turn around and use the data sciences to look for their exploration. I just don't want to own them. And that's the other big factor, is that a lot of the gold analysts on the sell side, you're getting less data from them, and they're the ones that are still around. They're embracing an old-fashioned way of looking at these deposits. So let me give you a classic. The NAVs they calculate are all based on discount rates that are different. Every analyst has a different discount rate. Therefore, when they say one stock is cheaper than the other, well, it may not be. There's no consistency. And then when they go with all-in costs, Ralph Aldis, runs our gold funds, was commenting that there are different factors that they throw in the bucket, say what's all-in costs. So the quant funds don't use those metrics, and they use other metrics. So the revenue for the last quarter over the past 4 quarters, is it rising? And when it's rising, it usually has momentum for 3 quarters up to 3 years. So it's better to be owning those types of stocks. Who has the cheapest cash flow returns on invested capital? Who has the highest free cash flow yield? These stocks with those factors will outperform. And so that's what we've noticed, that in the capital markets, how you have to be more selective in stock picking. So when we listen to one of your interviews, we want to go and run that stock story through our models to see, are they showing those type of results? So when it comes to the real junior explorers, what we have found is what's their reserves per share? Have they grown their reserves per share over the past 3 years, or the past year? Because a lot of guys raise money for lifestyle, but they never really went out and found more reserves per share, or they merged with another company and they even diluted it faster on how many reserves, or in situ reserves even, they had per share. But those companies that showed that they were increasing their reserves per share, they got buyers that were coming in. And it wasn't just golds in mutual funds, etc. They were also, by the world of the quantamentals that use screens, they're seeing those stocks, and they're the ones that get picked up.
Okay, let's move on to the macro perspective in terms of the global economy. And let's talk about negative yielding bonds. Is this a trend that is only going to continue going forward? And what does this tell you about the global economy in relation to gold? Are we headed for a global recession in your view, Frank?
Yes, and I think they're trying to stop it. And I think it's strangulation by regulation, especially of the EU, Karim. They back taxes. Well, I'm involved with the blockchain mining with Hive. And the issues we have to deal with, and the cost and the complexity of rebates. No, you're getting on energy. Yes, no, maybe. It's so complex and expensive, and it's so easy to stub your toe that actually cuts off your leg. So I think that what they're doing with this successive regulation, rather than waking up and saying, you know what, we have to streamline this stuff, that they're saying, well, let's just make the money cheap. And is they're trying to seduce and induce you and investors to go buy their 5-year government bond with a negative real interest rate. And you're going to say, well, I'm not going to buy that. And so they just print the money. They buy it themselves. They just print money out of money heaven. And the concern, and when I was on these global travels, is that the Bank of International Settlements of Switzerland that clears for 60 central banks, they really detest any crypto money and gold. And they are the ones behind a lot of the gold swaps to try to suppress gold. But I think something else is happening now in the sort of wake-up call. But I'm really amazed that there's not in the gold ETF fund flows. And I was talking with the head of research for the World Gold Council. I'm just so surprised there's not more money out of Europe going into bullion because of what's taking place. So I think there's panic buttons taking place out of Europe. The pressures in the U.S. now, especially being exacerbated with the trade war, to go to negative real interest rates is probably going to last until the election in the U.S. And so we've got another year, probably like 14, 15 months of trying to stop a recession. So I think that's what we're going to live with. And this is a very good backdrop for gold, because when gold hit $1,900, do you know what the U.S. government's year negative real rate hit? 300 basis points, minus 3% on your money. And then when it fell to $1,000, they were paying you now 100 basis points above the CPI number. Sorry, 200 basis points for 10-year government money. So we went from minus 3% to plus 200. That's a 500 basis point swing, and that's why gold fell down to 1,000 in dollar terms. Now it's rising in dollar terms. That is, the real interest rates are falling, and the CPI number is rising. So we have negative real interest rates. Gold is rising with that. And so having the Europe with negative rates, and we're seeing that in Japan, it's just a matter of time before we go back to 1,900 ounce gold and above.
Excellent. Okay, as we begin to wrap up the show, Frank, is there anything else you wish to discuss today? Perhaps your current thoughts on the copper market, for example?
Yeah, copper has to. Copper's getting just spanked because of PMIs and fear of recessions. Much more of a recession sort of barometer of a recession, along with negative inverted yield curves, is also another barometer of a recession. But what remember is that copper's so unique because we're in deficit for a second year now. And that means that there's just less and less copper supply. So any tick up in PMIs and copper prices can jump 50%. So that's something to buy on the dips when copper gets sold down. When it comes to gold, for those looking for income, what our funds owners are called the Grand Columbia Gold Notes. And they're listed on Toronto. They're like 8.25% of what they print, but they pay monthly, and they pay you more when gold is rising because they have a higher payout. But basically the yield's minimum 8.25%, but I think the run rate now is over 11% payout. They pay monthly. So it's a hedge against for a very stable way. It's not going to give you doubles and triples as you get in speculative gold stocks, but it does give you the opportunity to get a nice yield on a gold play. And and Grand Columbia is one of those stocks that have had a big turnaround where the Quant funds, and this is a classic example, they were trading 1,000 shares a day 3 years ago. They had $45 million in debts. Today they have $75 million in their balance sheet. Massive growth on value from negative to positive per share. The stock is up 500% and trades 100,000 shares a day. Why? It has not because gold analysts have recommended. It's predominantly because the quants have discovered it. And I think that's where this is like one of those classic examples of a mid-tier stock. So I think that's the unique way to look at these type of gold stocks.
Thank you very much for your time today, Frank. Always great to have you on the show.
Well, happy investing.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?